Hello, welcome to Strictly Money at the News Farm, where all voices matter. I'm your host, Saijal Patel. If you're like most people, you probably enjoy shopping online from the comfort of your home. And if you do, you will have noticed a different way to pay for your items. That is paying in installments using a third-party vendor. Buy now, pay later services have grown in popularity over the past few years. In fact, BNPLs are expected to grow more than 50% annually to close to $17 billion US by 2028. Joining me now to discuss the rise in popularity of BNPLs and what consumers need to be aware of is Doretta Thompson. She is the financial literacy leader with CPA Canada. Doretta, thanks for joining me.
My pleasure.
So I know the concept of paying by installments is nothing new, but this use of BNPLs have really exploded. I mean, even banks are trying to get in on this. Why do you think we've had this huge rise in its popularity?
I think that there are a few things that are driving the trend to this. One is just how easy it is. The digitization of buy now, pay later. As you said, it's not new. This has been around for a very long time. It sort of starts way, way, way back with the old layaway plans. The difference, of course, is that under layaway, you made your major payments every week or every month, but you didn't get what you were purchasing until you had paid for it. This, of course, you get and you pay in the future. Digitization has speeded everything up. And one of the key changes is that it's now available for almost any purchase, including very small discretionary purchases. And it is so easy to do. It's just like a click of the button. These are tiny, think of them as little tiny unsecured loans, micro loans, if you like, that are so easy to do. And people just love that.
Yeah, Doretta, I mean, you mentioned the layaway plan, right? And you always have this concept of that, zero down, no interest for a period of time as well, typically used for white goods or furniture. I know lots of people who have taken advantage of that. Can you explain then how BNPLs work exactly?
Yep. So basically, they're a point of purchase loan. So which means that as you are buying them, you get the loan right there. But they are not secured, generally speaking. The approval process is it's very different from, say, a bank loan where you have a credit check and things like that. And generally, one of the most popular models is something that they call pay in four, which is very popular for these small purchases. And then you pay it over 4 installments. Generally, what happens is you make the first installment when you buy it, and then the other 3 you will make at say monthly intervals or whatever it is. There are a number of different providers. They all have their own little rules and regulations. So you want to be sure you understand what it is that you're getting into. But basically, that's how it works. And it's interest-free as long as you make every payment on time. And that's the caveat, as long as you make every payment on time.
Yeah, and I think we have a board of some of the popular ones. There's PayBright, there's Saijal, Klarna is another one, and obviously there's so many more that are coming on as well. What I think is really interesting too, Doretta, is from a retailer's point of view and why they would do it. Because typically, from my understanding, is they're the ones who pay a surcharge or some sort of interest, depending on, of course, the terms. And I think the thinking around with retailers is that they get better conversions. I myself, this is really interesting because I'm struggling with this. I offer a financial literacy program, and yet my customers are asking for this type of payment plan, which is kind of ironic because I'm trying to teach them, good financial skills, and yet I want them in the program so I could actually teach them these things. Yeah, what's your take on, at least from the retailer's point of view? What's happening?
I think it's very interesting. I actually spent a little bit of time looking at the websites of these service providers, how they pitch them to retailers, and they pitch them to retailers on ease and on basically you will increase your sales, and they, some of them will have claims of up to 60, 75% in a year or whatever, because what you're doing is you're removing the friction in the sales process, right?
We've run out of time. Sorry, we're going to continue this conversation when we come back. Welcome back. I'm here with Doretta Thompson of CPA Canada. Doretta, we were talking about BNPLs. What do customers need to be aware of when using them? Because in some cases, they don't pay interest. And when they feel like there's nothing to lose, it can feel enticing.
There are benefits and drawbacks to everything. And the benefits of buy now, pay later, it does increase accessibility. You get interest-free payments. It can be a great emergency option rather than a payday loan, for example. So there are benefits, but the drawbacks are also considerable. The biggest one, from my point of view, is that it is too easy and really encourages reckless buying and debt accumulation. If you do it once and you have a couple, for some small purchases and it's $100 over the 3 months, the initial pay, that's one thing. But if you start doing it 3, 4, 5 times, it becomes very substantial. And then the penalties and the interest rates kick in. And that can be really scary. I've seen some data from the US, and we're seeing things like, the debt accumulation, especially for young people. Almost half of them who said that they were increasing their spending from 10 to over 40% since they started using these features. And 57% of those people regretted it. So there are some really interesting things to think about. A couple of other ones that haven't really been big picture noticed, et cetera, but ones that I would think about are issues like data protection and consumer protection. What happens if things go wrong? If you're not doing this through a bank, this isn't regulated the same way that financial institutions are. And I think those are probably issues that are going to emerge down the road.
Yeah, it's interesting. You're talking about consumer protection. We've seen in the U.S. The Consumer Financial Protection Bureau is now investigating into this, right? They're looking at the risks and the benefits. Are you seeing indication that regulators here in Canada are getting concerned?
Absolutely. The Financial Consumer Agency of Canada did a small benchmarking study that they released last year. They're absolutely concerned and looking at. I think regulators are very, very concerned about this and interested in how it's playing out.
Yeah, Doretta, you have a marketing background, and so you understand very well how much money and effort is used into enticing people to buy what they don't need. From that marketing standpoint, what insights can you give us? And how should consumers be thinking about it so they protect themselves?
I think that the big insight, if you really want to understand how marketers do something, is that you're always trying to remove friction from a transaction. You're trying to make it as easy as possible and as emotional as possible to want somebody to say, yes, I need that. Yes, I want that, and make it really, really easy to buy that. And when you put that online and you start looking at some of the digitization trends, you look at things like in-app shopping, where suddenly 2 clicks and a whim becomes something that's going to be delivered to your home in 2 days or 1 day or whatever. It can become a very dangerous thing, especially if you are if you have a tendency to do some impulse shopping. You don't have to actually make an effort and go out. So I really encourage people to get back to the basics of good personal financial planning, and make sure that you know how you're going to pay for something before you buy it, and try to put all of that friction, the things that slow down the process, put the friction back in for yourself.
Yeah, which
and
is
there
so
are lots of ways to do
counterintuitive,
that.
isn't it? Yeah. So what can they do? So what kind of friction can they put back in?
Things I generally recommend and that I practice myself, I will say, the first one is do not keep your credit card or debit card information online. Make sure that every time you're going to purchase something, you've got to go and you got to pull out that card and you got to enter it in. That just slows it down. Even if it's only a couple of minutes, it still slows down the process, right?
Yeah.
Another one that I think is generally a good idea is some people have a 1 hour wait period or a 3 hour wait period or even a 24-hour period, depending on the size of the purchase, before you actually hit pay. And a third one that I think can be very helpful is to keep a separate email account for online shopping.
Welcome back to Strictly Money. The next time you look at your paycheck, you will find that your take-home pay is less. That's because as of January 1st, your required contribution towards the Canada Pension Plan went up. The increase was more than originally planned, and in fact, the increase is the highest in 3 decades, thanks to, in part, the impact of the COVID pandemic. Joining me now to break down the numbers and implications is Evelyn Jacks. She's the president and CEO of the Knowledge Bureau. Evelyn, great to have you back.
Thank you so much for having me. It's great to be here, and Happy New Year.
Happy New Year. So this hike, it comes at a time when inflation is high and businesses are struggling. Why is it going up, and why is it more than what was originally planned?
So you're right, it comes at about time. It all started back in 2016 when we had legislation that was agreed to by the feds and the provinces, and it put into motion a series of hikes between 2019 and 2025 that's going to see our premiums rise from 4.95% to 5.95% and more. Now, the issue this year is that we always base our premiums on maximum contributory earnings and a ceiling level. And that ceiling level went up by a lot more, 5.3%. And that's because it was based on the average weekly earnings of people who were in the marketplace over a previous 12-month period. So when we compared what happened in 2022, 2021, we found that there were a lot fewer low-income earners in the pool because those people were most affected by the pandemic. And as a result of that, the maximum contributory earnings went up from about $61,700 to about just over $64,000. That means we're all paying more into the fund. And this comes at a terrible time when inflation is high, when businesses, of course, they're responsible for withdrawing those amounts off paychecks, but they're also responsible for paying 50%, an equal portion for their workers. So it crimps the amount of people that you can bring into your workforce because you have to bear this in mind. And if as a result of that, you're hiring more gig economy workers, we have an implication for them as well, because if they're not being hired on as employees, they're being hired on as gig employment workers, self-employed gig economy workers. They're going to contribute both parts on their own.
Yeah.
And we're going to be passing those costs down to them in full.
Okay.
But that's not good either.
No, it's not. You know, and I guess the point that we just made earlier is that there are businesses that are struggling, right? And inflation is high. Could they not have waited? I know there was a call for this to push this back. What's your thinking around that?
Like everything else in these times, and these are really difficult times and really unusual times, I think this is definitely something we have to look at pausing, because we have a fragile economy. We're still sputtering along, and we have to wonder whether or not it will be possible to at least put the brakes on this. Now, the problem is that we're going to have to get the agreement of the feds and the provinces on this, and so it's going to take time.
Okay. Who benefits the most from this increase? I mean, I guess the idea is they want to boost, retirement savings and benefits. But as it's happening right now, who benefits the most? And I guess in your mind, who also loses? Because I always say the devil's in the details, isn't it?
The devil's in the details, and ultimately the people who are going to benefit are people who contributed the maximum for 40 years consistently. Mm-hmm. So when we contribute today, we're contributing to the future retirement of those people. Most people will not see the benefits of this in their lifetime. If they're, at their peak earning years and they're at the end of the cycle. And therefore, we're contributing to the future. I think that's a good thing in many cases, but also because of where we are today, it's really important that people understand the mechanics of the CPP, because the CPP benefits alone are not going to fund, for most people, an adequate retirement. It will be one tool in your arsenal, but it will not be all the tools you're going to need to beat taxes and inflation. And remember that the CPP benefit is a taxable benefit.
That's right.
And if it is squeezing out contribution room to your TFSA, now a gig economy worker is going to be paying about $7,000.
Right. Welcome back to Strictly Money. I'm here with Evelyn Jacks. Evelyn, just before the break, we were talking about boosting CPP premiums, and part of it is to boost retirement benefits. Is this the only arsenal, or maybe the best arsenal that the government has? You were talking about this not being the only tool that individuals should rely on. Why not raise the TFSA limits, which has been at $6,000 for, I think, a couple of years now?
Mm-hmm. And they will raise eventually, because they are tied into a different inflation calculation. And so that's one of the confusing things about all of these different things that we have in our arsenal. We have the old age security, we have the guaranteed income supplement for low earners, we have the Canada Pension Plan. Those are our public pension options. Then we've got private pension options, and the TFSA is such an important part of that, because it's not taxable. We want to do that. We want to make sure that we take advantage of an opportunity to save $6,000 a year for our future retirement. It's not going to be taxable, but more importantly, your survivors are going to get what's in your TFSA. That's not true of the CPP. Your survivors are not going to get the full amount of your contributions. And in fact, when we look at the maximums, we see a maximum CPP pension of for 2022 is about $1,253. We see the maximum monthly combined retirement benefit for survivors, your own benefit and your deceased spouse's benefit, is $1,257. That's $4 more. And that means that if you both contributed to the CPP at the maximum through your entire lifetime, your survivor isn't going to get your whole benefit. They're going to get $4 more a month.
Yeah.
And most people don't realize that. So it's absolutely important that from an estate planning point of view, that you've got money into your in your TFSA. It's tax free. It flows through. The second piece of that is your RSP, and that's, of course, restricted to age. You have to be under 72, or your spouse has to be under 72 to contribute, and you have to have earned income. And it's going to be taxable, too, when the money comes out. But there's some planning you can do around that. You can decide, maybe I'll postpone my CPP and old age security to age 70. I'll take my RSP first. I'll average down the taxes while I'm doing that. It's actually a lot of fun to think about your planning of your RSP income, your retirement income, with all the buckets put into place, because you actually can benefit by paying the least amount of tax over time.
Yeah.
So that's where retirement income planning, it's complicated, it's fun, and you'll see that it actually puts more money in your jeans.
Yeah, especially when you do have those tools and you know how to navigate those tools. You know, it's interesting that you talked about the spousal or the survivor benefits, because my understanding is that Prime Minister Trudeau has asked Finance Minister Chrystia Freeland to work with the provinces to increase the amount that's paid for those CPP survivor benefits. And it's one that I have talked about a lot, because I can see, especially when women typically live longer than men, that they have this undue burden, right? What's your take on that, and how likely do you think that's going to happen?
Again, we are going to need to see agreement between the feds and the provinces, but I hope it happens too. I have to wonder why only 25%. Remember, your spouse contributed during their entire lifetime.
Yeah.
And so a joint last to die kind of scenario on the combined CPP premiums would be the ultimate hope. And so if we're aiming high, why not 100% of your spouses contributed and do retirement benefit until you die.
Yeah.
But if we have to settle for 25%, it's better than what we've got now, as I've explained.
Okay. Evelyn, thanks so much for coming on today. We really appreciate your insights.
Oh, it's my pleasure. Thanks for having me.
That was Evelyn Jacks, President and CEO of the Knowledge Bureau. That wraps up this edition of Strictly Money. If you have questions or feedback, drop me an email. And don't forget, you can catch previous episodes by subscribing to the News Forum on YouTube or Facebook, or follow me at Saijal. Thanks for watching.